All right, so it looks like we are up and running. Taking a second for it to finish running all the way through. There we go. That's got to turn that off so that we don't get some feedback. Cool. Yeah, my dude, we are here alive and well.
No, we're going.
Yep, and the computer is holding up. Sweet. What's up, everybody? I started it a couple minutes early to run through some technical tests since I am an absolute idiot and don't know what I'm doing. So it looks like everything is working okay, but if you guys can, when you make your way in, let me know, say something in the chat, just say hello, that would be great. But that'll give us a heads up that it's working. So cool. Otherwise, I'm seeing green across the board, and I think we're in a perfect spot to start. Yeah, so Shrey J and Joe are both in here. They both say it's working, which is exactly the goal. What's up, dudes? Good to see you guys. All right. So what is this segment? Well, I've done a bunch of different versions of these over the past years. I actually think Shrey J was on one of them not too long ago. Well, actually a while ago now that I think about it. And these are kind of different focus level series to get us closer, zoomed in on both the technical side and the practical side, specifically of trading options, is what this is going to be all about. So this first video, I want to introduce you guys to Kyle if you're not familiar with him. I've done a bunch of content with him on his channel before. We've worked together for a while now. He's a great dude and he's familiar with options. I actually think he's probably at a commensurate level with the majority of the people, at least in my options Discord, which there's a familiarity, but not super in depth. And it's definitely not at a professional level yet, anything like that. Still figuring out how they fit into the broader picture. So with that, what I want to do is quickly recap what we covered in the last series, because for those that don't know, might not have caught it, for the last few weeks, I guess since we were doing it every other week, it's a bit longer than that, last couple months even, we were doing something on Kyle's platform called Optional Experience. And this is where I took him and our friend Blaine from a very rudimentary understanding of options and kind of got us to a pretty practical level pretty quickly. So this is not going to be like an options 101 series. I'm actually going to drop a video in the chat for those that kind of need that. Like if you're not familiar with what a call is, what a put is, this is not going to work super great for you because we're kind of picking up where we left off. So in the chat, I just threw in a very basic level video for you guys that need that. But first off, Kyle, great to have you, man. Welcome back on. I don't know if we've done, I guess the last thing we did would have been the service reviews that actually people really liked, but I got over after doing a handful of them because it was nothing but talking shit.
Yeah, those were, I can see the need for them, but yeah, it's kind of tough because we didn't find anything really all that great.
Yeah. And I realized also that I very much am very picky. Like that came through exceedingly much in that, yeah, exceedingly much in that process where I realized I am very picky, which I don't know, man, it served me well. So fuck them. So because, you know, this is a little bit different than, I don't know, Kyle, what you're used to, at least on my YouTube channel, I think we're not really known for being the consummate professionals, maybe that you guys are known for over on your side. And actually most of my YouTube sessions, I am shirtless. So I'm going to get into uniform.
Oh,
so
Bert.
So that this way I am ready to get on with the show. I got called out yesterday by one of the people in my community. So I'm not ready to do that. Oh, interesting. So I'm just getting a notification from YouTube saying that the bit rate is a little bit too high, which is very curious. So that's good to know. On the next one, maybe I'll turn the bit rate down. I don't know if that'll help us. Joe says dual streaming on OnlyFans. Listen, motherfucker, got to pay the bills somehow. So if there's a couple people, I'm telling you, there's got to be a kink somewhere for traders and sex. Like, it's got to be a thing. There's got to be an overlap.
It's probably a foot using the mouse to place trades.
So to tell you guys one of my favorite stories ever, I was a young buck in my early 20s at this time, and I was seeing a girl. And at one point, I had been talking to her about options because, shocker, I talked to everybody about this stuff. So even somebody that I was seeing at the time, I was still trying to get them to trade options. And long story short, there was a point where I was literally doing a bunch of studies on my computer. And I'm not kidding you, she was super horny. She wanted to have sex. And I was telling her that I was in the process of like studying the different variations of long puts. And I kid you not, she said, well, I want you to long put your dick in me. And I loved that line so much.
Oh my God.
Dude, it was so well done. We ended up having sex right after that because how could you? It was just so perfectly executed. But I was.
Did you call her anything?
Dude, I couldn't stop laughing at first. It took me a hot few minutes to like even be able to turn the switch because it was so fucking funny the way she said it. Because I was like, I mean, she was like pawing at me for a minute, and a lot of you guys know, like I'm obsessive. So when I'm in the process of doing something, dude, it could be the end of the fucking world, and I do not care. Like I am going to continue doing whatever it is I'm supposed to be doing. But yeah, that was like one of my favorite things ever. It was so funny, dude. Absolute blast. Oh yeah, perfect. So Kyle dropped in the options playlist from.
That's the Spotify one.
Yeah, perfect. So I threw that in there as well. All right, you guys. So that's enough of the preamble. You guys kind of have an idea of what this series is all about. So I'm going to do you all a favor, and I'm going to get our faces out of the way because nobody really wants to look at us, and I do not blame you in the least. And let's get into what we're going to be talking about. So the segment today is very much of a recap. And my hope for you guys is, especially for the people that are following along live, is genuinely to participate alongside of us. There is a lot of efficacy behind different levels of receiving information, right? So things like taking notes as you're listening is known to help a lot. There's a bunch of things you could do to increase your uptake. But a lot of it is also teachbacks. So that's actually what I want to spend a few minutes doing up front with Kyle, is having him teach back to me some of the things that we covered in the last series to set us up for carrying this series forward. And just so everybody understands, it's not easy to be in Kyle's position here. Like that's just what it is. It sucks. So
I have no idea what you're going to ask either.
Yeah, which is perfect. That's exactly what we're going for. So the goal here is to make sure that Kyle at least has a rudimentary understanding. He's not prepped on any of this. So we are going to be doing this live with you guys. You are seeing a genuine human being that's relatively new to options, probably very similar to you guys, going alongside this live. That's the level set here. So there's no like prepped content. Nobody got to see this stuff first. So what I do want to start with, though, is some qualitative questions up front. These are kind of like the softballs. And the reason why I want to start with some of these is to get an understanding of your understanding of derivatives. So when we think about derivatives, if you were to explain it like I'm 5, what is an option?
Like you're 5?
Like I'm 5.
That
Maybe
might be
like I'm a
tougher.
smart 5-year-old.
So an option is basically just a contract that gives you the right or the obligation to purchase shares at a set price at a set expiration. Depending on whether you're the buyer or the seller, whether or not you have the right or the obligation. The purchaser has the right, not the obligation, to take those shares at the agreed upon price at the agreed upon strike or expiration date. Whereas the seller has the obligation to provide those shares to the person who purchased the contract from them, should they choose.
Anybody in the chat, can you find the error in what he just explained to us? It was close.
Uh-oh.
Yeah, you got a
one did I miss?
couple. Yeah, you got a couple of the big things on, no problem. But there was a specific thing that I honed in on there that definitely was incorrect. And I'm curious if the folks in the chat can identify it. So if you're quick and you could throw it in, do it now. If not, I'm going to give the answer, and then I'm going to pretend like you didn't know either.
We see the chat through the Zoom, or is it? Okay, I don't.
Yeah, it's on YouTube. It's on. So if you go to my YouTube live, so you can go to my YouTube channel now on your browser, and then you'll be able to see the chat. Just kill the sound. So that it doesn't create a feedback loop. Tom and Shrey, both of my boys are on it like white on rice. And my favorite part is neither of them are white. So it's kind of like the mix on rice sort of thing. It's you guys aren't white on rice, but you're acting like you're white on rice. Maybe we'll go with that. But that's exactly right. So what Tom and Shrey are saying is that you're highlighting one side of the equation, which Tom says brown on rice. Brown rice is a thing. So you could be brown on rice, I suppose. That's fair. But you honed in on purchasing. So for example, if somebody buys a put, what do they have the right to do in that scenario?
They have the right to sell at the strike.
Yeah, man. Yeah. That's exactly it. So excellent job for Tom and Shrey. You guys both get one fake internet point, and we'll definitely keep track of those for sure. And you guys are tied right now.
Cool. Tom and Shrey, I'll write them down.
Yep. Well, I was joking because I definitely was not. I was just going to make them up every time, but that's cool.
I will give them points.
Good. Well, they both get +1 fake internet point. Cool. So now let's take a look at some specific questions. Boom. We kind of hit this one a little bit.
Yeah.
So quick recap then. Who has the right?
The buyer has the right. The seller has the obligation.
Always. Good. So the reason why this matters is because when we're talking about options trades, this inherently will influence some of the decisions that we get to downstream. So this is a very easy starting point for us. Next one. If we have an options position that is on, how can we neutralize an open options position?
How do you mean by neutralize?
Close, flatten, exit.
Okay. So you can either just sell it or buy it back, depending on which side you were on to start with. You can exercise it.
Okay.
You can roll it, or you could. No, that wouldn't be closing it out. That'd be starting a new one.
Yep. And it's also
selling. Could you turn it into a leg, like a spread?
The chat is helping you here. Check out the latest one from Joe.
Oh yeah, buy the shares. Nice. That's a good one.
No, Adrian. Not buy the shares. It's the last two comments. Adrian got it too.
Expires worthless. Yeah.
Bingo. Yep. So the three primary ways an option position can be neutralized. The guys hit the top ones right out of the gate, which is closing it, right? So actually transacting the option itself. Then you hit on part of the second way, which is exercise it if you're the holder, or wait to be exercised if you're the seller. And then the third choice, exactly as the guys got it there, is bring it to expiration. So those are hands down the most common ways to handle an options position. Now, there's a lot of bum statistics out there, which, as you guys know, really grinds the old gears over here. So with that, how frequent are these different scenarios? Can anybody instruct me?
Wait, which scenarios?
Whether or not an option is closed out ahead of time, or whether or not it is taken to expiration, or if they're exercised.
Well, there's a stat that's always thrown around. This is the one that you hate, that like 70% of all options expire worthless. But I believe we
is a
debunked
stat.
that in a previous episode.
Yep.
I would think the majority of them would be closed out before expiration. But
Okay.
that's just a guess.
So we have one believing that we close out most frequently. I see two guesses here from Wheelstrat, Joe, and Adrian that expires a ton. Most would close out. Joe says closes second, extra fries third. I don't know what the fuck happened. But okay, so you guys are close. The vast majority, 70 plus, Tom guesses close too. Tom, I would give you a fake internet point, but because I know you personally and I know that as a Marine officer, you know you're supposed to be confident, even if you're absolutely full of bullshit. I guess close to is way too non-committal, so you get 0 points for that. But I would give the fake internet point to Adrian. He got it. So close it. That is hands down the most commonly way to flatten / neutralize / close an options trade is to close it by trading the contract itself. Then out of that remaining bucket of taking it to expiration, more expire worthless than are exercised, which probably inherently makes sense to people, but that is the case once they're taking to expiration. But the vast majority are closed out ahead of time. Could you guys give me some ideas as to why that's the case? Why do we think that the vast majority of time they are closed before we go into expiration?
Because typically you still have theta decay that's on there, and you're just throwing that away if you just hold on to it, if you're planning on grabbing it anyway.
Definitely part of it. Joe says scared money. I don't know what the fuck that means. So maybe the money's scared, maybe it's not. Adrian says cut the tail risk out. That is also incorrect, especially if you're a buyer. It doesn't really matter. Now Joe's getting into it. Joe says no cash to take the stock. So what happens is, so Joe, you now get one fake internet point. The reason why that is so frequent from a buyer's perspective is twofold. The primary reason is you don't want to move the underlying. You just wanted to trade options for the leverage. So there's no part of you that wants to take shares in or out. The second thing is you can actually salvage some of the time value, exactly as you were saying, that's left in the option. So that's why early exercise is so rare. Because if you exercise something early, you could have recouped the time value in the option. So speaking of early exercise, to throw another question out there, when are we at risk of early exercise?
If you're a seller, you'll be at risk, and you'll be more at risk if you're coming up on events like dividends, because people will exercise the shares in order to make sure that they're part of that X date.
Will they? So if
some will. It's more likely, let's say.
How do we know? So let me give you an example. If I sold a put, what happens?
Well, that would be a different story.
That would be, wouldn't it?
Yeah.
Any guesses from the gang on when a short put would be at risk of early exercise? Why Not says good evening. Yeah, what a fucking great time to join. Why Not? Kyle's in the middle of getting murdered here, and you just come in happy-go-lucky saying hello.
I'm giving Why Not an internet point for that one.
Adrian says if it's in the money, that's great.
Yeah.
Now, there are different qualities of in the money. Shrey says when extrinsic is less than dividend, that's not correct on the put side, Shrey. Mario says when in the money. So this is a great example. So let me find something that has a dividend coming up. Do you guys know anything that has a dividend coming up quickly?
Not off the top of my head. When does BP pay theirs?
Let's see. Upcoming dividends. I want it in the next 3 bars, that's fine. Don't worry, boys. We'll find something. We'll give this a second to run. So to delineate right out of the gate, there's a big difference between if we are at risk of early assignment, whether you're trading a call or a put. There's a big difference. So right out of the gate, if you are short a put, early assignment risk, not really a thing as it pertains to dividends. So if you sell a put, I don't know why that just crapped out on me. If you sell a put, here we go. It's a completely different scenario. So let's take a look at CNI. When is theirs? CNI. Their dividend is the 6th. Man, these guys are dirty. So to clarify even more, it's not when the dividend is. I thought the scan would be smarter than this. Oh, ex-dividend date. Okay, good. Yeah. Okay, good. So this is saying this is the ex-div. Okay, cool. Yeah, we're great then. Good. So let's take a look. The ex-div date is 6 December. Okay, so let's take a look at some options. If the dividend here is at 2%, you can calculate the value of the dividend off of the last price, right? Because that's when it's going to go at ex-div. So because I'm not good at math for Marines, we're going to do 117 times 0.00202. So the dividend is going to be like 23 cents, something like that. So here's the question. Which of these calls would be at risk of early assignment? The answer is just about anything that's cheaper than the dividend that you would be receiving in this scenario, because you make more money. So that's why you would exercise early, take the shares on. You're giving up that extrinsic value, but you can make more by receiving the dividend, by holding through the ex-dividend date. So that's when the calls are at risk of early assignment. Now, puts become at risk of early assignment if there's a really big disassociative move between where the underlying is, where your short strike is, and how far in the money you are. So the reason why I don't give you guys fake internet points on the short put side for saying in the money is because if this 120 right here is in the money, this is not at risk yet of early assignment. Could it happen? It can, because again, remember, the buyer has the right. So a random buyer could choose to exercise just because they hit the wrong fucking button. That can happen. It can be completely illogical. That can still, unfortunately, get paired up with you. It's an assignment process. So boom, you're now the person that's going to be obligated to be on the other side of that trade. So sometimes you can have something that's exercised that makes no financial sense. Super, super rare, but it does happen, and it's important for people to know that can happen. So anyways, on the put side, you start to become at risk when you are deep in the money and there's essentially no extrinsic value left. The easy way that I explain this to people is essentially if you are sub-dime, meaning in terms of extrinsic value, there's less than 10 cents, your probability has now just gone up quite a bit compared to if it was greater than that. And then the further you get into that, the higher the propensity it is. The vast majority of the times I've been assigned early, specifically on like an index ETF, because that's the most I've been early assigned on. It's typically when it's trading about 6 cents is when I've been assigned early. So just to give you an idea, and I can't open my Excel sheet right now because I don't want to crash the live stream to give you an exact number on how many times I've been assigned early, but it's not trivial. It's more frequent than people might expect it to be. So it's important for people to be aware of that when we're talking about these things. So I'll take a pause there real quick and see if anybody has any questions on this assignment process and early assignment. Not exactly what I was expecting to get into, but that's the point of these, right? We go wherever we go. Does that all make sense?
I think so.
So you dig it?
I did. So I was just checking the comments. Yep.
Yeah, totally cool.
Yeah, I'm trying to think of I did get assigned one time. I think it was British Petroleum, actually. I was I think I was in a covered call and I got assigned when it was deep in the money and right before dividend X date. They took my shares away.
Mm-hmm.
It was about a week or two before expiration. Yeah.
That's definitely a thing. Mm-hmm. Let me take a look. Mario saying, so deep in the money is at less of a risk in this case. Negative. So for CNI, a deep in the money short put would be at a higher risk of early assignment, to be very clear. These markets are super wide. So you just have to do the math to see what the extrinsic value is, which is actually a great follow-on question. How can I calculate the extrinsic value of this option?
You just subtract the difference between the strike and the actual traded. So 160 minus 41, and then subtract the price of the contract from that. And what's left over should be the extrinsic value.
This is actually a good segue. Nope. This. Let's focus on the second part of this question. What are two components to an options price? There's two specific buckets that make up the value of an option. What are they?
Intrinsic and extrinsic value.
Okay. Intrinsic value. How do we calculate intrinsic value?
I don't remember, but I figured it would be based off of the actual price of the share relative to. Right. And if you can figure out the extrinsic value or the intrinsic value, you just subtract that from the options contract, and that should give you what's left over is the extrinsic.
My man. So then why don't you walk me through that here then? So let's take a look at these 160 puts. Adrian is spot on. He said extrinsic and intrinsic. So Adrian gets +1 internet point. Tom is asking, I'm giving you a second to do the math there, by the way. I'm just going through the questions. Tom is asking, you mentioned in one of your videos, you can unassign yourself. What does that mean? It's kind of a joke. It's a play on just the role concept versus, it's like a play on the role concept. But essentially the way you unassign yourself is exactly what it sounds like. Let's say I had these 125 short puts in CNI and I was assigned early. All I would do is exit the position. So in this case, if I sold puts, I would be taking on long shares. I would sell the shares. I would do the math on the loss that I realized and then sell options that then cover that loss. It's just more bullshit wizardry when it comes to accounting, but that's essentially the process that I would follow. And I have done that before in IWM for sure, because there are periods where I'll get assigned early at a basis that is higher than I want, but I was also willing to have more risk out. So I will happily close out wherever I'm at a loss. And then I would sell more at an improved basis via short puts that cover the cost of that loss. That's the idea. But anytime that we think about this, the idea of rolling or anything like this, it's just different ways to account for things. And that's essentially the process of quote unquote unassigning yourself. Adrian says intrinsic is strike minus current price. So Kyle, walk us through then the intrinsic value for this 160 put.
I took 160 minus 117.21, got 42.79. And then I took the average of the bid and ask to get the midpoint, and then subtracted that from the 42.79 and came up with 11 cents.
Bingo. There it is.
Got one.
That's perfect. Yeah, exactly. So you get one fake internet point. AJ says, aren't you ganging up on the possible loss then in that unassignment process that I just gave him is what he's referring to. And 100%, you absolutely are. You're also increasing your risk. There's no free lunch out there. So in that scenario, especially if you're adding more size, you absolutely are increasing the risk profile. That's why I made that very important caveat that when I was talking about doing that, I already wanted to have more size on. Because if I didn't, it would be literally a terrible choice. I talk about this a lot with people because I think traders, they go through this phase when it comes to scaling in and scaling out of trades, where first traders scale into losing positions because they're trying to average in and be able to exit at a better time. Essentially, in this case, we were throwing good money after bad money. Then you get to a point where you realize that that's bad and you stop scaling into trades that are coming down, which is good. Then you get to this point where you become very discerning between when you're adding money to things because of conviction and you can trust yourself versus the early scenario where you're just throwing good money out of bad money, trying to get out of something early. Because I've definitely scaled in and I continue to scale in on losing positions, but that's always when I have a vested interest in expanding my footprint to that position. That's it. If there's ever an instance where I don't like that underlying anymore, the last thing I'm going to do is scale into it so that I could try to get out earlier. That is a terrible idea. And it's a very fine line. So I actually think for newer traders, the best thing you can do in that scenario is just do not scale into losing trades. That's it. Until you get to a point that you can trust yourself a bit more, because the psychological function that's going on under the surface there is massive. Cool. How is an option valued, Mr. Kyle?
Oh boy, it's a function of, like we said, the intrinsic value. The extrinsic is calculated by a bunch of factors, which we call Greeks. The main ones are going to be
negative.
No, I'm already wrong.
Yep.
Okay.
Incorrect.
Well, let's see then.
Let's see if the chat can help him out. You can keep thinking through it though. So when you think you were on the right path, so we have intrinsic and extrinsic value. You did a good job breaking it down into those two different buckets. Extrinsic value, you rightly highlighted as the part we're interested in. Intrinsic value, we already generally know. Good. So the guys here are giving you exactly the correct details that you need.
That's what I was trying to say. I was going through the Greeks.
Right. The Greeks have nothing to do with this. The Greeks are irrelevant. Wow. The Greeks give us information on how options behave. That's it. They have nothing to do with how we value the option. So,
but they are the factors that you're looking for, the time, volatility, that, or no?
Some of them. So if you think about how we value an option, there's a set of criteria that come into how we calculate one specific part, which is this question here. What is the only unknown input when we're using something like the Black-Scholes model, or even a binary tree, or whatever pricing model? If you're creating your own volatility surface, what is the only unknown input when you're trying to calculate the premium of an option? Real Shot Joe says price. That is incorrect. So you now know not to say that one.
Yeah. Well, we should know what volatility is. We know what time is. We know.
How do we know what volatility is?
I guess we don't. We know what volatility is now. We don't know what it will be in the future.
So,
or we know what it was in the past. We don't know what it will be going forward.
So volatility is the only aspect of an options price that we don't know. We know if it's a call or put. We know what the price is relative to the underlying. We know how many days to expiration there are. We know what the risk-free rate is. So we know if there's a dividend coming up. We know all of the primary components of pricing an option, especially if you're using something like Black-Scholes. Now, a couple notes here. First, the way that an option is valued in our world as retail traders is by supply and demand. We're not the ones pricing any options. So if you come in here and you look at, let's find something that's actually a little bit liquid as compared to this. So if we look at the SPY and we look at 45 days out, this is trading at 717, 716, whatever. Whatever you come up in your model doesn't matter. It doesn't matter at all. You might be able to forecast, in your opinion, if something might be too expensive or too cheap relative to what it is, but it's baked in by supply and demand. That's how we get to prices. So market makers are the ones who are typically resting these bids and offers to provide a market. That's what's happening here. Now, we talk about options and we use things like the Black-Scholes formula to give people an idea on how you can price options. And Black-Scholes is really useful in a lot of instances, but there's a lot of shortfalls with it. It's why it doesn't work in a practical sense. It's only appropriate for European style options. Big drawback. It assumes the same volatility for an expiration. That's not the case. We know different strikes within an option chain have different volatilities. The point being is Black-Scholes is a theoretical model. It's not what's actually happening. What's happening here are market makers and other institutions. They have their own volatility surface. That is a calculation that they are using based on previous information and projections to say, based on these inputs, this is what I think the value of this option is. So the only part that's unknown in this is volatility. That's it. Now, there's a reason why when we talk about the implied volatility of an option is because implied is where we are forecasting where it's going to be in the future. But more importantly, the implied volatility as we talk about it can be derived from the price. We can see what the market is valuing the option at. And you can use the Black-Scholes model for that to isolate volatility, and the platform in this case does it for you. So in this case, the 457 puts here, they're calculating 13.32% volatility in them. So you can derive that using something like the Black-Scholes model. Make sense?
Yep.
Beautiful.
I knew you were going to trick me with that one.
What are 4 reasons to trade an option? What do you guys got? Wheel Stretcho says, next question worth 2 points. How many likes can we get on this live stream? It's a great question because as folks are coming in and coming out, I mean, it wouldn't kill you, I don't think, to just hit the like button. You know what I mean? Like as you're moving around on the mouse, like just click that motherfucker and then we can all move on happy with our lives. It's a great point, Joe. I'm very pleased that you brought that up. But I would also be very pleased if we know some of the reasons why we might trade an option. What are some of them?
So speculation, leverage, hedging.
I'm gonna axe the first one because it's too broad. It's not wrong, but it's just a little too broad. The second one is spot on, which Ken's got it, make it rain. Tom's got it, leverage. Adrian's got it, leverage. So apparently we got a bunch of fucking junkies in here because leverage has come through loud and clear. So that is one reason why we might trade options. Joe caught you up to hedging.
I said hedging.
Okay, good. So we have 2 so far. Yep.
And you wanted a little more detail on, well, you also have volatility to trade volatility.
Bingo. That's a massive one. It's a slept on one, but it's a massive one. The reason why I highlight the capacity to trade volatility is because there are not many products out there that you can trade as a Delta One product and get a pure exposure to volatility. It's an asset class of its own, essentially, and options give you access to it. That is completely accurate. What else you got? Talk to me a little bit more about what you meant by speculation, because I think that was on the right path.
You threw away my speculation. It's a way to take a position on a stock without having to fully put, you don't have to put the full risk on, and you can also get more with the leverage. So I don't know how else to describe it. Help me out, Chet. Arbitrage. What is that?
So Joe says arbitrage, which it could be a reason. That's not what I'm thinking of, but it could be. Ken says a directional trade. So let's unpack that a little bit more, because that's where I want to go with it. The idea of speculation is correct, but like I said, I want to get a little more into detail on it because the type of speculation matters. Because you could speculate in Delta One products, you could still do that. You can speculate on Delta futures, Delta One futures, right? If you're buying the futures contract outright, that's all speculation still. So the reason why option speculation changes a little bit is a few reasons. One, you can decrease idiosyncratic risk. And what that means is you have the opportunity to pursue different styles of returns. With options, you can trade things up, you can trade things down, you can trade things sideways, you can trade things for income. There's a lot of different ways you can trade an options contract that you cannot do with the Delta One product. So Kyle, your point on speculation is spot on, but those are some of the specific aspects of speculation that are unique to options compared to other things.
Right. You can capitalize on different ideas using different structures.
Yeah, exactly. Because, for example, if the market is trending sideways, unless you're really good at rotating long and short, those are very difficult markets for stock traders to make money in typically. You can make great money in options trading in that kind of market. We saw a lot of that this year. So that is one of the premier differences when it comes to options versus other things. And we have 2 questions left. Second to last. Explain like I'm 5. What is volatility? And why the fuck do we care? Volatility, for anybody, it can be explained in one term.
Movement?
Yeah, that's good. I think that's fine. Okay. Yeah. Ken also says movement. I would give it to you. So the way that I would classify it is variance. Variance is a subset. It's a type of dispersion. Both of those 2 terms would be kind of the specific one I'm looking for. Is dispersion is a class of kinds of movements, and then variance is our distance off of the mean. So it looks like you guys got it. And then J5D called me out. He said, explain like I'm 5, movement. And you are absolutely correct. That is 100% accurate. Adrian says unpredictability of price. Not so much, because you can have things that are actually quite predictable if they're range bound, but they could still have a lot of volatility. So in that case, you don't necessarily have to not be able to predict it. That can be an aspect of volatile markets for sure. If something moves a lot, but it's the movement itself, not so much whether or not it was predictable. But things that are unpredictable tend to have more volatility. So they move hand in hand with one another. So that is spot on volatility, essentially what it is. And then for the why do we care, it looks like AJ has the answer already. What do you think, Kyle?
I'll take a stab at it too. I think it's because, as you highlighted earlier, it's the one thing that's unknown. And because there's unknowns, that's something that we have the opportunity to look for opportunities.
That's exactly it. It's because that is what drives option pricing. That's why there's a lot of anomalies and opportunities there. Tom says that's our edge. That's a great point because it's not inherently our edge, but it can be an aspect of edge. For example, if I'm really good at trading directionally and I'm using leaps to trade directionally, volatility in that instance, not so much my edge. It's my capacity to trade directionally very successfully. However, to Tom's point, if you're trading a known market inefficiency, like variance risk premiums, that can be the direct source of your edge. So volatility can be a source of your edge. I wouldn't define it as the only source of edge in options trading, but I like that. Last question. What are the 4 primary Greeks and what do they measure?
Put your screen back up. No, I'm just kidding. Theta, that is time. Vega, that is volatility. Delta, that is how much the price of the options contract should move with a dollar for dollar change in the underlying. So if the underlying moves $1 and it's a 0.3 delta, the price should move by 30 cents.
When you say
Of the
price, what are
contract.
you referring to?
The price of the contract, the options contract itself.
What's the other term for the price of an options contract?
The premium.
Bingo. The reason why I bring that up is because it's kind of like when you're talking about a percent of a percent, a lot of times you'll use the term points to differentiate. It's the same thing in options. I find it best if traders, especially early on, use price for the underlying and then premium for the options. Again, it's just a stupid thing that I think about just to reduce confusion.
Actually, not stupid at all. It makes perfect sense.
Yeah.
And then the last one last of the 4 primary should be gamma, which I believe, and I don't remember exactly how it works, but it is basically telling you how delta should change with price. Is that correct? Okay.
It is. And then what did you say for Vega? I don't remember.
Vega was the volatility measure or component.
But what does it measure?
Oh. I would have said volatility, but since you're asking me that, I'm guessing that's wrong. It'd have to be something to do with the price component that volatility makes up in the contract itself.
Very close. So Vega is the change in premium per 1 point change in implied volatility. J5D says Vega
J5
equals percent increase in vol, increase in underlying. Yeah. So it's not necessarily a percent, to be clear, but yeah, it's the change in premium per point move in the underlying. Yep. Or in IV, sorry. Yeah. You nailed it. So
got one.
Talk to me about your first quiz. This is the easy quiz. We will have more coming down the pike, probably for every session we have, but it will be fewer questions, but definitely harder questions. Talk to me about how you feel about this quiz in general.
I feel pretty good, actually. I think I had most of the information there. I think I got slipped up a little bit on trying to explain some of them, but the knowledge was there. Once chat helped me out, I was able to get those ones that were kind of eluding me. Yeah, I could have done a lot worse, but I could have done a lot better too, I'd say.
That's totally fair. And the reason why I like doing these is because there's a really delicate balance between like the theoretical understanding of options and then the practical side. But maintaining solid understanding of the theory is important. So, and Joe brings up a good point. He says, Greek info changes over time, so it sucks. That is true. Nothing in markets is typically static. So that is absolutely accurate, but it's very telling. It gives us a ton of really usable information. So it's actually good that they move around. All right, so let's talk a little bit about our homework. Kyle, you already have your trading plan started and your trading log, so this won't be anything new to you. But for the people that are following along with us on the series, this is your homework. And if you have one that you've started already, that's excellent. What I would love for you to do is to drop it in our Discord and to look for somebody else who dropped theirs in the Discord and essentially swap them with one another. The reason for this is to get you guys repetitions reviewing things, because you have to become an expert at poking holes and stuff. And then it also gives you an opportunity to seek somebody else's perspective, which early on can cover a lot of the gaps you will have in your process. Now, for you and I, Kyle, on the next one, you and I can just review yours. And it doesn't have to be super far in detail, but what I want to make sure is that the framework is there, because that framework is what we're going to spend the rest of the series building off of. And then the last thing I want you to do, which I know you're already doing, again, this is for the broader chat, is to place 3 paper trades and outline the hypothesis and the P&L management plan. Now, for those in the chat, even when we hang up on the live session here, I want you guys to drop it in this video as a comment, and it's because it will give us a reference point for when we get on the next one, because I'm going to grab a bunch of them from the comment section. Even if you're watching the recording, I'll grab a bunch of them so that we can review them together. And Kyle, this will give you an opportunity to review other people's trade ideas, gives you a chance to critique their stuff, which is very useful, again, for both the people being critiqued and then you critiquing, because then obviously I will look at your stuff as well. So, do we have any questions on the homework?
Do you have
Beautiful.
any resources that you'd like to share or point people to help them if they've not thought of that before?
What, the trading log?
Trading log, trading plan, either.
Yeah, okay. That's a good point. I have a video I'll drop in the chat on trading plans. Boom. And if you need any details on that, let me know. Joe says, can they be live trades? Yeah, they definitely can be live trades. It's whatever you want. Whatever trades you choose to put on, it could be live, paper, whatever makes you happy. I will say, though, for anybody that is new to trading, the last thing you should probably be doing is placing any sort of live trades. I would wager most would be better off paper trading. Not all, but most. But hey, that's just my 2 cents. What the fuck do I know? You know? So that's your homework for the next session. And then the last thing I want to give you guys is a quick overview of what I want to cover in the next session. So I want to spend the first bit reviewing trading plans, and I really want to make sure that we have a solid understanding of the structure. There's a lot of content I've put out on these, so I'm not going to spend a bunch of time reviewing the basics again. I'm going to spend way more time talking about the practical side of it so that as we're going through the rest of this series, you can smartly build yours out to maximize the time on this. And then the other thing I want to be doing right out of the gate is getting us to practical application. So in this case, it's going to be reviewing the paper trades, but I want to walk us through different processes for finding trades, how we consider adding trades to our portfolio, those kinds of things. So that will be the lion's share of the next session.
Awesome.
Any questions?
No, I'm just hoping that we get to cover something that when we get to that point, I'll have some questions that as far as like managing risk throughout the trade that I'd like to cover, but I will save that for next week.
Yeah, that's perfect. That's exactly perfect, because the P&L management plan will cover that exact thing. So I absolutely love it. All right, gang. Then that wraps us up. Obviously, don't forget to like, subscribe, share. You can always find Kyle. Go ahead.
So hit that. Oh, wait, how do we do this? Hit that thumbs up button and put it in Big Daddy Erik. No, that didn't work. Never mind. I thought I had something.
Not your
there.
best.
I was trying to reference back to your options joke, but just didn't quite work.
Yeah, I actually, now that I understand the context, it's better. I still like my Rihanna one that got canceled from yours, which is a bit
I
of
reworked
a
it. That should work. Slap that thumbs up button like you're Chris Brown on a first date.
There we go. There we go. Now we're talking. There you go, guys. You heard it here first.